Alibaba runs China's biggest AI cloud platform, which is also one of the biggest on Earth, and trades at a PEG of just 0.2. They are growing their AI cloud business by 40% year over year, are profitable, and statistically one of the cheapest large caps on Earth. But when you buy its ADR, you don't own Alibaba. What you do own is a Cayman Island shell company. And that's a risk a 0.2 PEG cannot calculate. And it's not the only one hiding in plain sight. Today I will look at 4 AI stocks. All look cheap on paper. But each one is hiding a risk the multiples can't show. And only one of them is truly cheap. When investors scan for cheap stocks, the first number most of them look at is the PE ratio. Price divided by earnings. This is simple and intuitive, and for a lot of situations, it's really useful. But it has a blind spot. Because a company growing 5% a year at 15 times earnings isn't the same deal as a company growing 30% a year with 30 times earnings. The second one is actually cheaper. You are paying more upfront, but for a lot more growth underneath. That's what the PEG ratio is designed to fix. To get it, you divide the price to earnings by the expected growth rate. A value below 1 generally means that the growth isn't fully priced in. And above 2 means that it's more than priced in. It's a simple adjustment, but it changes what you're looking at. Take the 4 stocks that we're covering today, for example. On raw PE, nothing stands out. ASE Technology at 29 times, not cheap by any obvious standard. Alibaba at 20 times, reasonable but not striking. Nexans is similar. And Sterlite even looks pretty expensive with 71 times forward PE. But if we look at the PEG, this picture changes. All 4 companies have a PEG of 1 or lower. That was my selection criteria for being cheap. ASE at 0.7, Nexans at 1, Sterlite at 0.7, and Alibaba a whooping 0.2. That's not a mistake. One of the largest and fastest growing AI cloud operators on Earth trades at a PEG of just 0.2. And 3 of these 4 stocks come in at or even below 0.7 on a growth adjusted basis. That's not just a little cheap. That's a huge discount. But if these stocks are so cheap, why aren't institutional investors buying them? Why does the whole market seem to walk right past these names? Most of the time, there is a good reason that a stock is cheap. And in each of these cases, the reason is something a PE or a PEG simply cannot calculate. But that also gives rational investors who are willing to look past these surface multiples a chance to lock in a really cheap investment. So let's look at these companies to find out where the discount is coming from and if the seemingly cheap price is really a good entry point. And let's start with the largest physical bottleneck in the entire AI ecosystem. You can design the most sophisticated architecture in the world, but if you want to turn a silicon wafer into an actual functioning AI chip, you have to package it first. And nobody in the whole world does that at a larger scale than ASE Technology. So while companies like TSMC build the chips themselves, ASE brings them into a package and combines them so that they can be used by end customers without breaking instantly. Bloomberg expects this market to grow by 26% annually until 2033, which is double the speed of the overall semiconductor market that they project to grow by around 10% annually. And ASE's advanced packaging segment, here called ATM, is where the AI revenue is concentrated. This segment makes up 64% of the overall revenue and has been growing by 30% year over year, while at the same time expanding their margins. When we compare the fundamentals against the closest US headquartered peer, Amkor Technology, ASE wins on every line. Better margins, higher return on equity, bigger scale and bigger growth, and more advanced packaging capabilities. And it still trades at a huge discount to Amkor on forward PE and forward EV to EBITDA, with a PEG of only 0.7. The reason for this is straightforward. Amkor is headquartered in Arizona. It has CHIPS Act support. It's building an advanced packaging campus in the US. ASE's primary facilities are in Kaohsiung. This is about 100 miles across the Taiwan Strait from mainland China. And the market isn't wrong to price that in. In August 2022, for example, China launched a live fire drill simulating an island-wide blockade for Taiwan. ASE fell over 40% from the price it had earlier that year. The PE compressed to single digits even, and the stock didn't recover until late 2023, over 1 year later. And while the recent military exercises in 2024 and 2025 didn't have the same severe impact on the stock, the valuation gap between ASE and its US peers never really closes during calmer periods, and we see this valuation gap since ASE became available to trade on Western stock exchanges. Now, there is one thing I want to note, because this becomes important for our next company. ASE is a sponsored ADR, and one ADR equals 2 underlying Taiwanese shares. That means that foreign investors own direct equity of the company. No offshore shells, no proxies. So it's essentially as if you were trading the company directly. Now, the counter-argument to the proximity to China is the silicon shield. The idea that a physical disruption of Taiwan's semiconductor infrastructure would trigger a global economic depression. So both Western and Eastern powers have a rational incentive to maintain the peaceful status quo. ASE is also hedging its own footprint, expanding assembly lines in Malaysia and even buying up European manufacturing asset with the acquisition of the French EMS provider Asteelflash. So while the valuation multiples could see a cyclical recovery with the packaging revenue scaling at the current speed, it can't calculate the very real risk of a Chinese blockade or even invasion of Taiwan. So the discount isn't irrational, but it's asymmetric. If the status quo holds, you are buying a better business at a cheaper price than its US peers. But you are essentially buying a geopolitical wildcard. The next company is Alibaba. They run China's largest cloud platform. Its Qwen AI model family competes directly with Meta's Llama and is one of the strongest, if not even the strongest, open source LLM available. They even build their own AI chips similar to Google's TPUs or Amazon's Trainium chips. AI cloud revenue is growing at 38% year over year and already makes up a substantial part of their overall revenue. The business is profitable and growing. Their operating profit is even expected to double by 2027. And the PEG is still only at 0.2. At this multiple, you are paying almost nothing for the growth. It's the most compelling valuation in this group by a wide margin. Its forward PE is almost even only half of that of Google and Amazon. So why aren't investors rushing in? If you scream geopolitical discount again, you're wrong. Because in contrast to ASE, if you buy Alibaba's ADRs, you don't actually own Alibaba. What you really own is shares in a Cayman Islands holding company. This is a shell that controls the Chinese operating business, not through equity, but through a complicated web of contracts. That shell company has no operational business. It merely holds contractual rights to the profits of the actual company via a variable interest entity or VIE structure. This is a workaround for China's restrictions on foreign ownership in certain sectors. And usually it works fine. Until it doesn't. Because unfortunately, we have seen this in the past. In July 2021, the Chinese government declared, for example, that education and tutoring companies must register as non-profit organizations and can no longer make a profit or accept foreign capital. This caused Gaotu and Tal Education, the biggest names in this space, to suffer a 90+% crash for offshore ADR holders pretty much overnight. It was not a bad quarter or a write-down. The company was fine, but the Chinese regulation changed, and the stock went effectively to zero. Then we also had Didi, a Chinese ride-sharing platform that you might remember. When they listed in the US, national security and data security concerns overrode international shareholder rights entirely and forced a delisting. Alibaba itself went from $319 in October 2020 to just 58 euros in October 2022. An 82% drawdown in just 2 years. And the discount versus US hyperscalers, which was 10 to 20% before 2020, has never closed again. And even though the immediate threat of a delisting has been paused due to the temporary auditing access, the underlying risk has not been resolved. And with the way the relationship between China and the US is going, I would not rule out that the delistings will be started again. Still, Alibaba's top line is growing, they have a very clean balance sheet with massive amounts of cash and are buying back shares with one of the largest buyback programs in all emerging markets. Only their free cash flow has suffered from the increased capex spending, but that's still pretty much the same picture as for the US hyperscalers. So, despite the cheap valuation, I still think that Alibaba is not irrationally cheap. It's a discount for the risk of delisting, and because with the ADR, you don't actually own the company here. In fact, from all our 4 companies today, I am most skeptical of Alibaba because you don't own what you think you own. And AI makes that even worse. We've already seen that AI is quickly becoming a matter of national security, so the government interest in these companies is already quite high. Now, if you like this kind of objective analysis and think that it helps your own investing, hit subscribe. I post up to 2 of these videos every single week. And now, let's come to our plot twist. Because the first 2 companies on our list had massive risks. So you might assume that the next company is also cheap for the same reasons. But it isn't. Nexans is a French company listed directly on Euronext Paris. There is no geopolitical risk here. There are no military exercises. There is no offshore shell company in the Caymans. If you buy Nexans, you own a business operating under the laws of the European Union. So what does Nexans actually do? They manufacture submarine and high voltage cables. The infrastructure that connects offshore wind farms to national grids, and increasingly, the cabling infrastructure that connects data centers to power networks. And look at the comparison with their peers. Prysmian and NKT, who are the closest peers, are trading at forward PE of around 30. The US companies Eaton and Belden both have a slightly different focus, but are still the closest publicly traded peers in the US. Eaton is trading at a PE of 31, and only Belden with 15 is cheaper than Nexans' 22.3 ratio. And Nexans' forward EV to EBITDA is even by far the cheapest of the group. Their PEG is a perfect 1, which means that their valuation is actually pretty much in line with their growth. Fundamentally, the company is very healthy. They have divested their lower margin business and transformed into an electrification pure play. The backlog in their power transmission segment is 7.9 billion and gives a good revenue visibility until 2028. They are projecting a return of capital employed of over 20% for 2028 and are riding the exact same tailwinds as their other counterparts, providing the high voltage cables and grid connections to power the data center boom. This gives them a growth expectation in the mid-single digits. Not as high as the others on our list, but remember that this growth expectation is already included in the calculation for the PEG ratio. So why is it then so much cheaper than their peers? First, we have the coverage. Eaton is covered by 24 analysts, and Prysmian, which has a much higher market cap than Nexans, is covered by 20. Nexans, on the other hand, is only covered by 14, and mostly from regional European banks. So they get a lot less coverage than the others. And because it doesn't trade on a US exchange, the vast majority of US retail brokerage accounts literally cannot buy it. Major US pension funds are structurally restricted from purchasing foreign assets directly on overseas exchanges. And because it's listed in Paris, it receives exactly $0 from the massive index flows driving the S&P 500 and the Russell 1000. The market isn't scared of Nexans. It isn't pricing in a geopolitical event or a legal structure risk. But a large part of the market simply doesn't see and know the company because of its size and location. Don't get me wrong, Nexans also isn't a highly volatile small cap. But with close to 7 billion market cap, they are still classified as mid-cap by most financial institutions. But that's what makes this the most compelling mispricing of the 4 companies. Because it's not because of structural or political risks. It's just because a large part of the market simply can't see it. But for an international investor who can buy the stock on the European exchanges, Nexans' valuation looks very appealing right now. Our last company brings us to the fastest growing digital ecosystem in the whole world, India. If you want to play the massive 5G rollout, fiber to home, and the infrastructure buildup in the fastest growing country on earth, Sterlite Technologies is the dominant domestic player here. On first glance, their valuation doesn't scream cheap, with a forward PE of 71 and a forward EV to EBITDA of 29. But their PEG is still only at 0.7, which shows the insane growth the company has. But I have to be completely honest here about the differences between a structural discount and fundamental problems. Because compared to the other companies from our list, they do have a significant amount of debt and their net debt to EBITDA ratio sits at 2.7. Still below my threshold of 3 that I have for my investments, but higher than the others. The margins, especially the free cash flow margin and the net profit margin, are also close to 0, and so is their ROIC. So at least part of the cheap PEG is earned by the fundamentals. But why did I even include it in this list here then? Well, because there is a second layer. And this is the structural discount that sits on top of the fundamental one. If a foreign investor wants to buy Sterlite directly on the National Stock Exchange of India, they can't just click and buy. They have to register as foreign portfolio investors with SEBI. And that comes with a huge checklist. You have to clear regulatory hurdles, secure a local tax ID card, and hire a domestic custodian. Then every single trade is hit with a security transaction tax, and foreign capital is subject to India's capital gains taxes. And on top of all that, you can't just convert rupees back to dollars. You need an authorized dealer clearance. So the paperwork for a simple investment is a nightmare. Not to speak of the taxes. But there is a massive silver lining here. Because the government in India just made some major reforms earlier this month that make it easier for foreign investors to buy Indian stocks. The Indian brokerages are working on updating the backend to implement these changes and remove some of the paperwork as we speak. So the current multiple includes thin margins and a high debt load. But even after an already pretty good run this year, it also still includes the structural barrier for investments in India that is currently eroding quickly. So the tailwind is real, but watch the leverage before investing in them. So we have 4 stocks with entirely different reasons for the discounts. All of them at or below a PEG of 1. And that teaches us a valuable lesson. Every time you look at a non-US company and stumble upon a low PE or PEG ratio, it doesn't automatically mean that the company is cheap. The market is just pricing something that doesn't show up in the multiples. And the edge, if there even is one, comes from identifying what that something is and deciding whether you are being compensated enough for it. Is it a geopolitical risk, like for ASE, where the operational metrics are great, but you are still underwriting the risk of a business disruption in the case of a war or disruption in the Strait of Taiwan? Is it legal risks, like for Alibaba, where the business is also great, but you don't own it, even if you purchase the ADRs? Is it poor visibility on international markets, or is it a restricted access, like for Sterlite? Knowing which bucket a stock falls into changes the entire risk-return perspective. The valuation might look the same on paper, but the mechanics are completely different. From our companies today, the discount for Nexans is the most likely to go down when international investors actively search for European industrial exposure with massive secular tailwinds. On the other hand, we have geopolitical or legal risks like we see for ASE and Alibaba that might even be semi-permanent unless the geopolitical landscape shifts. So the multiples can tell you if a stock is cheap. But only identifying the underlying risks can tell you if you are being compensated enough to own it. And that is the actual edge. But as always, that's just my opinion. Now, I would like to hear from you. Which of these stocks would you be willing to own? I am actually curious to see where most people draw the line. So please let me know down in the comments. And if you would like to know why SoFi's growth never shows up at investors' side and why their shareholder returns are much worse than you might think at first glance, watch this video next. And as always, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.